Let's kick things off here. So everyone, thank you for joining. We're pretty excited to break down a little bit about what's happened, especially the last quarter of the year. We're already halfway through. Isn't that crazy? And yeah, there's a lot happening, especially in Surrey, White Rock, and Langley. I know a lot of you in the pre-survey said you're renting or looking for your first home. There's a few investors here as well. So yeah, everything we talk about will be very much directed towards acquiring real estate and also getting the right financing. So with that, we're going to kick into the agenda and then do some introductions and talk all about all the good stuff that's happening. So Alex, why don't you introduce, drum roll, the agenda?
Sure. Have you shared it with me, the screen? Or the
the remote access?
Please, sir.
Okay. I'm trying to figure that out. I will DJ for now. So on the agenda.
All right, well, I'll get us started. So our agenda for today, we're going to give you a bit of an intro into who myself, Alex, and who Paul is. Then we're going to step into the first step in the process, which is pre-approvals and some mortgage basics, which Paul will take you through. We're then going to speak on the differences between mortgage brokers and banks and what you should be looking for. Paul then dive into banks versus wholesale lenders. We'll then move on to the most common mistakes and mortgage surprises to try and avoid, why your accountant and mortgage broker and brokers aren't friends if you're self-employed. So if you're self-employed, definitely attention here. I'll then take you into the real estate market trends during and previous to COVID. We'll then talk about where the market is right now, how it's changing, and where we're going to be headed. We'll then go through the new home buying experience, the buying process itself. Then we'll look at pre-sale versus resale, which one makes the most sense for you. And then my favorite slide of this entire presentation, you're going to want to stick around for this one, is the Fraser Valley hotspots and investment opportunities. And something that I'd like to clarify up front, when I speak of the Fraser Valley, this is the Fraser Valley Real Estate Board. So this is Surrey, Langley, White Rock, North Delta, Abbotsford, and Mission. We're going to be focusing primarily in the Surrey, White Rock, and Langley areas. But if I do say the Fraser Valley Real Estate Board, again, it encompasses all those areas. So then we'll go to a question and answer period. So if you have questions, please put them in the question and answer box during the presentation. We'll try and get to them after. We have a ton of information to cover, so we're going to try and rip through this for you guys. But let's move on.
All right, cool. So, Alex.
I'm just going to kick it off a bit, give a nice little plug for Paul, but Paul is not your average mortgage broker. So I know a ton of mortgage brokers and they're typically quite introverted, a little bit bland, no offense to them. They like to sit behind their computer, but Paul is the complete opposite. Super outgoing, has a massive network, and this guy is a serial entrepreneur. One of the coolest things he's actually did, and about 6 years ago, he was on Dragon's Den pitching an idea. You guys can look him up on YouTube afterwards, but this guy's just leveling. He's just all about leveling people up, building connections, and just trying to help young individuals basically improve their lives in many different forms. So Paul, take it away.
Thanks, Alex. Now, that was when I had a few less gray hairs. So you can look that up on YouTube. Good times. But just a bit about me. So, I mean, I'm all about, as the name says, leveling people up. I think like the biggest thing is that school didn't really teach us some of the things that gives us the best financial gain. Like, can we agree with that? Like any side of school around financial literacy, I think there's a lot of things they left out that we start to find out the hard way, especially as an entrepreneur. You just figure things out as you go. And it's funny because I think a lot of people on this webinar are extremely smart and hardworking. I mean, you're taking time out of your summer evening to learn about real estate. So clearly we filtered a really good group of people here. Now, what killed me is that a lot of people that come to me are in your shoes. They're an early investor or a first-time home buyer. And it's crazy how many people get routinely turned down by their local bank, for example, or they get approved at a bank, but they get what they thought were the best rates, but really they're subpar rates. And they tend to not remember or actually be aware about the fine print. So things like mortgage penalties. And it just baffles me that every hour out of every day, someone's actually either leaving money on the table or losing thousands of dollars within a 5-year term. All things I'll talk about. But as I learned more about that, I really just got obsessed with how do I create like great transparency in how this crazy industry works with lenders, realtors, mortgages, but also, actually like distilling things in a hopefully a simple and fun way. Cause this is actually pretty cool stuff once you learn a bit more about it. And at the end of the day, I don't know if it's the bank's fault that people aren't very, as educated as they could be with mortgages. I think again, it's a mixture of our educational systems that have to improve. And yeah, I think at the end of the day, it's about you knowing what questions to ask. Because at the end of the day, you're the boss, right? You have your realtor, your mortgage broker, your accountant, you have your financial planner. You almost have to be the one who asks them the right questions. And that's exactly what I want you to do, right? So as Alex was saying, I've had, I guess, the opportunity to be in some pretty interesting entrepreneurial positions the last decade. I grew up in near the UBC area, and I've been sort of, I guess, the last decade, I've come from the marketing and the technology world. And end of the day, some of the things that I've learned from that is I've learned to raise thousands of dollars, millions of dollars sometimes, for either my company and/or we've been doing a lot of sales. We've been selling not just what we do, but our people. In the investment world, it's all about selling your people. So I found in the mortgage world, it really is about selling you. And only you can sell yourself in the best way. But there are certain ways that lenders look at your financial health. And my job is to sell you in the best way that I can, but also to make both of our jobs easy. It's about you understanding what the goals are and how lenders look at things. So I'm super excited to go to war with you. It sounds a bit dramatic, but it can be that when you are about to get an offer accepted on a home and you need that mortgage approved. So I get a thrill out of these things. I'm really excited to work with you guys on at least equipping you to be self-sufficient with this. And yeah, a bit about our actual brokerage. We do $5 billion a year in mortgages. We've got a pretty big team. So we see a lot, and we have a lot of access to lenders, which what that means is, of course, there's rate exclusivity. The more business we send them for certain lenders, we actually get more exclusivity on rates, which is great. And you'll find out through the presentation, or let's say call it our dialogue, there's a lot of interesting ways for you to afford more. And that's also one of the biggest problems, especially if you're self-employed, it's affording more. And of course, this webinar will be on the YouTube channel, and I have a lot other resources that I think might be interesting, depending what your questions are. So thanks again for that quick intro, Alex. Excited to meet everyone. And if I can introduce Alex for a little bit. So Alex, as a lot of you know, and I know we had some comments that you found out about this on TikTok, which is awesome. Alex is very progressive. And I think what's really cool about Alex is that like he's super humble and like one of the hardest working people that I know. Like he works so hard to not just promote this dialogue, but to actually like work on the content, recite it, make sure it's as accurate as possible. He loves his numbers. And one little fun fact about Alex is that he was actually in the Little League World Series when he was 12 years old. And this is actually something that's aired on ESPN. And for those people who watch sports, like about ESPN, you probably know about the Little League World Series. So yeah, obviously Alex is a slugger, always has been. And what I love about Alex, that aligns a lot with my values, that he's not a pusher. I think he'll tell you about how he doesn't like pushy people. He's about educating and consulting. That's his bag of chips, and he's about empowering you. So Alex, why don't you jump into a bit of your intro? I want to just at least start off with that and give the unbiased opinion on how awesome you are. But now it's your turn.
Yeah, I appreciate the kind words, Paul.
Yeah, you bet.
But, a little bit about myself. Born and raised in the city of Surrey, grew up in Fleetwood, have now shifted over to Cloverdale. But I am a licensed realtor at Remax Treeland Realty based out of Langley. So I work with both buyers and sellers in residential real estate across both the Fraser Valley and the Greater Vancouver regions. Now, I do the majority of my work in Surrey, Langley and White Rock, as I've mentioned, but I do venture outside of those areas as well. Now, a little bit about Remax, and the reason why I joined them is that they are the most recognizable brand in the world. They are in over 110 countries. And the average Remax realtor does almost twice the number of transactions in a year as another realtor. And that isn't to brag or anything like that. It is just that RE/MAX holds their realtors to a very high standard. They do not allow any part-time agents. And as I know, it is tough enough to keep up with the market on a full-time basis already. So I don't even know how you would be able to do that. But I digress. Anyways, can we
yeah, let's do it.
a couple through there, Paul?
Yep.
But before I kind of get into a little bit about myself, as a realtor, my aim is to educate and guide clients to make confident, well-informed decisions to achieve their personal and wealth-building goals in terms of real estate. So what I mean by this is I am here to educate, consult, and guide you in order for you to make a confident decision at the end of the day. I want to lay out all the options for you. I'm not here to push you. I'm not here to tell you what to do. I just want to help you come to that conclusion yourself. So previous to my real estate license, I actually got a bachelor's of science in kinesiology at SFU. So I was very into sports, health, nutrition, still very passionate about it. As Paul mentioned, Little League World Series, I actually forgot, I have a teammate that's on board. So Nathan, how's it going? Nathan actually continued to pursue baseball, got a scholarship out of it. I kind of just fell off. I peaked when I was 12, but what can you do, right? So the way that I actually kind of got into the industry is my mom had done it for over 10 years. And for a long period of time, I thought, you know what? I don't want to be that salesman. I don't want to be that pushy bulldog guy in your face. And it was just one day that I had a switch in my head, a switch flip in my head that I realized that you don't have to be that person. As again, Paul mentioned, I'm not a pusher, right? I just like to educate, entertain, and just make the whole process fun. But anyways, enough about me, Paul. Let's take it away.
Sweet. Thanks, Alex. All right. So let's get into it. So a bit of a story. Well, a couple of stories. There's a lot of people that I talk to, and they're obsessed with finding the cheapest rate for their mortgage, which makes a lot of sense. They want to save money. But what a lot of people don't realize that I've talked to recently is that sometimes to find the best rate, you actually need to have a very good qualification. So you need a very good income relative to debt, or else you can't access the best rates. Also, there's a lot of people that I've been talking to that they pay their bills on time to the T. But what I actually even learned, very recently as I got into the industry was that guess how much of a percentage of your total credit score is influenced by you paying your bills on time. I'll give you guys a few seconds to think about that. I originally thought it was at least 90%. So if you voted below 50%, you're on the right track. It is 35%. So a lot of people actually have a credit score that's below what the lenders actually need, and they pay their bills on time. But there's other things they do that sink their credit score, and therefore they don't qualify for the best rates. Last thing is, I think like a lot of people don't realize how much the minimum down payment is for the value of your property, which there's a sliding scale for certain parts of it, and we'll get into that pretty soon. But those are all very common things that I see, and it really blocks people from even being able to prepare. Even if you are 1 or 2 years out or 6 months, you can always prepare early and have that goal. So the key factors really are, and just so I can clarify what a mortgage pre-approval is, that's something where you can essentially get vetted by a broker or a lender, and they basically tell you that you have a good chance of qualifying based off of your documentation. So first of all, the key factors are, look, rate is not everything. It's about saving. Another misconception is rate is actually not the only way to save. You can save in a lot of other ways. There's actually different parts of your mortgage product. There's different features that influence how much you save. So for example, if you get a 2% rate, but you break your mortgage early, which I think it's 60% of people break their mortgage early. I'll say that again. 60% of people break their mortgage early because of them moving cities, selling their home, unfortunately getting, let's say, a divorce, life events they can't predict. But also sometimes people actually break their mortgage. So if you have a 5-year term, let's say, right, you will exit to get a rate somewhere else. And what that happens is that you trigger a penalty. And we've seen as high as $40,000. So that 2% rate turns into 4%. So you really got to ask the questions around, how do I save the most long-term based off where I'm going? It's not just about the rate. Talked about income level. There's basically a special ratio, a magical ratio, where they look at your debt and your income, and it has to have a certain ratio to it. If you are too over leveraged, or if you have too much debt relative to your monthly income, then for a lot of lenders, you will not qualify. So that's really important to pay down your debt. In fact, if you have a high net worth or you save a lot and you have a lot of debt, your actual net worth doesn't really matter unless you really make a lot of money. So always pay down debt if you can. And now credit score. Who knew the minimum credit score the lenders need? For that matter, who actually knows their credit score? I mean, it's something that you don't really get a lot of visibility on, even when credit card companies check it, right? So as of now, you want to have at least a 680, right? You want to have at least a 680 score. That gives you access to most of the lenders, and some banks can be a little bit more flexible. They'll give you a 620. Down payment. So you've probably heard, oh, you can do as low as 5%. Well, here's the catch. It has to be only for homes under $500,000. Now, if your home's between $500,000 to $1 before $1 million, it's basically 5% on the first 500K, and that's $25,000. And then you take the difference of the first 500 and the next 500, and you do 10%. So just a bit of math here. If your house is worth $600,000, you subtract the 500,000, you're left with 100,000. 10% of that is 10,000, and you add that on top of the first 5% of the 500,000, which is 25,000 plus 10,000, 35,000. If you're a little confused, don't worry. This is stuff that I can do with you, but you just have to be aware that the down payment really relies off, how much you're putting in, how much the value of the property is, and if it's over $1 million, it's 20% at least, right? And you might have heard that if you pay over 20%, you don't have to pay the mortgage default insurance, which is something that basically, every mortgage needs to have default insurance in case you default. The banks or any lender will make you pay for it out of pocket, which is usually about a premium of 0.8 to 4%. And that put it this way, it'll be about $12,000 across the term of your mortgage. This is the full term of your mortgage. Now remember, terms for mortgages are anywhere from 25 to 30 years. It can be more, but that's the average. So it'll be about $800 a year that you would pay on that, but you can bypass it by having more than 20%. So that's something you want to keep in mind for sure. I get a lot of questions on things you need, and I'll kind of rip through these, but these are all things that you probably do with your accountant. If you're self-employed, you want to have your T1. If you are self-employed under a corporation, you want to have your corporate financials. Pay stubs are important. If you work obviously with an employer, you want to have a letter of employment. These are all things that are, they're pretty basic paperwork, so don't stress about it, but just know if you have these lying around the house, like I do sometimes, definitely hold on to it because you'll need that for later on. Yeah, really important. And by the way, I guess Alex talked about the areas he covers. I'll be clear. I cover all of BC and also all of Ontario. So for mortgages, you can basically cover a lot of ground. The lenders are generally open to any area. But yeah, just an FYI as far as the areas that I cover. Let's go to, working with a mortgage broker or your bank. So I know, Alex, you have a story about this, which I thought was hilarious. So why don't you tell it?
I do, yeah. And actually, this slide was my idea. Paul didn't necessarily want to put it there because he doesn't want to be sitting here, pumping his own tires why you should use him. But I wholeheartedly believe 99 out of 100 times you should be using a mortgage broker. So I want to start you off with a little story of exactly why. So I had a client, she was self-employed. We were selling her condo and we were moving her up into a townhome. So once it was sold, the first thing that I ask every single buyer is, do you have a mortgage broker and have you been pre-approved? So she said, yes, I have a friend that works at the bank that does mortgages and she has pre-approved me. I'm qualified for this amount and this is my interest rate. So now we go and start shopping. We're looking for townhomes. We find that ideal townhome. It's actually in a brand new complex and is the very last unit. So now we're on a time crunch on two ends, right? We have to find it by the time that she moves out of her previous place, as well as we're trying to lock it down before someone else comes in and swipes it from us. So the offer process, get an accepted offer, and then all of a sudden we find out she actually can't qualify. So we're freaking out. She's scared she's going to lose it, not going to have a place to go. Luckily, I'm able to get her in contact with one of my mortgage brokers in my network. She actually qualifies her for more and at a lower rate, so her monthly payments were lower. And if we had just done this in the beginning, it would have saved major headaches. And I just can't stress enough why you should use a mortgage broker, but we'll get to that on this slide as we compare banks to mortgage brokers. So A bank can only offer you their own products, which creates a clear bias. And the example I'll give you here, if you walk into a Volkswagen dealership, they're not going to tell you, oh, you know what, I don't think this is right for you, go buy a Tesla. Of course, they're going to push their own products on you. So reason number one. Reason number two, they're much stricter and they typically reject more borrowers with self-employed income. So it is very, very important that if you're self-employed, you should use a mortgage broker. But if you're on salary or a more conventional type of income, they still provide a ton of benefits as well. Now, you have to present documents to the banks every time you go there. So if you decide, you know what, I want to go shop around at banks on my own, you're going to have to present all your documents every single time, do all this work on your own. It's just, it's a hassle. There's really, why do that when you can have someone else do it for you? Now, the individual that you go see at the bank, most of the time, they don't only work in mortgages. They're working with TFSAs, other sorts of investments, and this is just one of the tools that they do. So they don't specialize in it, as well as the fact that they are on a salary or hourly basis. Now, they're going to get paid whether they help you or not. So they really have no incentive to help you. And next is, so restricted hours and communication. So banks typically, they close at 6. Some of them are closed on weekends. If you run into problems while they're closed, you're not going to be able to sort those things out. So again, it's just not beneficial.
Yeah, and when you're like crunched to remove subjects, which I guess Alex will talk about, like when you have to confirm financing and you're on a deadline or they keep your deposit, you want communication hard and fast. So yeah, that's a huge thing for sure.
Yeah, so I've been in this situation before. It is not fun when you're worried about losing, your 5% deposit. Again, that could be $20,000. So it's just, you don't want to be in that situation. And then after the transactions occurred, after you got that mortgage, you're just a number to the bank. They don't really care about you after the fact. They're not going to build a relationship with you. They're not going to stay in contact and support you. They're kind of just done and forgotten about. Now, mortgage brokers, well, first of all, they can shop around at many different lenders, many different banks. They can even shop at the bank that you went to in the first place. And many times they can actually get you a lower rate and qualify you for more at these locations. And this, again, is very important for self-employed individuals, just because there's a little bit more creative financing and things you can come up with based on your level of income. So again, yes, they can afford more and get you lower rates.
Yeah, and that's a big thing too, because you'll find that unfortunately you will qualify for less than you want. So they'll say, yeah, you qualify for a $300,000 home. Like, great, thanks a lot, So you want to afford more, and there's tricks to basically boost your income and count other forms of income beyond just your salary, right? Could be child tax benefit, could be rental income that you have with your roommate, all kinds of things that you want to get creative with.
Yeah, and then, so as I had mentioned before, you can go shop around at all these different banks on your own, bring your documents every time, present them every time, waste all this time, or have the mortgage broker present the documents to them once, and they're going to go to the banks and different lenders for you. So you're going to save a ton of time. And guess what? Guess how much extra it is? $0. It doesn't cost a thing to have a mortgage broker work for you. They're actually paid by the lender. It's almost kind of like a finder's fee.
And
so,
that's the same for a buyer's agent as well. It's like you will do a lot of buyer's agents.
So yeah, I guess I should mention that now, is that if you're a buyer's agent, a realtor who's helping you find a home, again, there is no fee there. The seller actually pays both the listing and the buying realtor. So you're able to access both of these experts, both of these professionals free of charge. So it just doesn't make sense not to. Again, sorry, I just had that question come up, but I should mention, there are very, very few circumstances where you would have to pay a small fee to a mortgage broker, but these are situations where you're in bad financial standing and you wouldn't have been able to go to a bank anyways. So they would disclose it to you up front if this was a situation. Hopefully none of you are in this kind of, financial distress, but again, you would be able to make your decision from there. Again, greater access and communication. You're going to have, maybe not 24/7, but you're going to be able to have their personal cell phone number, call them at any time, and they're going to be able to help you out. They don't just kind of like turn off for the weekend.
You guys can just slide into my DMs. No problem. Yeah. Without send them a TikTok.
Exactly. And then they're going to provide you with continued support and a relationship after the fact, right? They're working on your goals over a long-term basis. They're not just going to turn you away. They want to work with you to help build your wealth portfolio and climb the property ladder, as well as support you with any other issues that may arise in the near future.
Totally.
Turn it over to you.
Thanks, Alex. And yeah, and look, that's most good mortgage brokers obviously vet them. And that's a whole other story. But yeah, like a good mortgage broker should be doing all those things. There are people that have been in the industry for a long time, and for lack of a better word, they're very comfortable in their ways. Just sniff that out quickly and you'll know. But like, you should have a high expectation for anyone that you work with on your team as you get on this journey. And I think that's really, really important. Look, wholesale lenders. This is actually an article in the Huffington Post. I can link to it probably in a follow-up email if you guys like. You can also actually probably Google this title. But yeah, they expose the banks that, of course, are comfortable to go to because you probably bank there, your parents bank there. But they're usually the worst deal around as far as rates go. And that's what's kind of brought up this huge surge the last 15 years of what are called wholesale lenders or monoline lenders. And these lenders are not to be mistaken with loan sharks or private lenders. Those exist and are useful for certain circumstances, but these are very legitimate organizations with, millions and billions of dollars in funding. A lot of times they get funded by actual banks, which is kind of funny, and they're held to the same regard as the government holds with the banks. But they're the wholesale lenders that no one knows about. They don't have any retail locations. A lot of them only work with brokers, but they're hungrier for your business, so they'll have better rates. And not to bash banks, by the way, we work with a couple really great banks, and some banks can be awesome depending on your circumstance. So I'm just going to break down the big banks versus the wholesalers and give you a bit of the nuances on how I allocate deals. So the main banks that I work with are Scotiabank and TD. They're great in their own regard, and I'm sure a bunch of you bank there. I know I do. And with them, basically, they're not as flexible to what Alex was saying if you have self-employed income, but they're more flexible if your debt to income ratio is a little tight. So if you have a bit more debt than you should and a bit of a shorter income, they can make exceptions. The wholesale lenders actually can't really, because their investors hold them to a very high regard. With a bank, they're giving you their money. These wholesale lenders is not really their money, it's from their investors. So that's just a little industry tip on how that all works. But basically, they can be flexible if you have, like a really low credit score, or a low credit score, not a really low, because they can't do that. Or if you have a tight debt to income ratio, and those are things that I can do with you, of course, once I kind of assess you. But that's one thing. Secondly, you've maybe heard of a HELOC, home equity line of credit. And that's when you basically have a secured loan against your home, and you might want to pull out money as you pay off more of your mortgage. You can actually pull out equity out of your home, right? And there's some great programs, especially with Scotia, where you can pull out a revolving line of credit. So you can kind of take out money as much as you want until a certain point as time goes on. So it's cash as needed for like a renovation or things that hopefully are really important. Hopefully not too many vacations, though. They don't really discriminate against that. But yeah, they're good for those sort of things if you need cash in the future. And if you have foreign income, or you're looking for $1 million plus a mortgage, then yeah, they can be a lot better there. But it's just a few things that they excel in, and could be a fit for you. But generally speaking, they fall short in a lot of things, and like no one knows. It's probably the best kept secret of the finance world, but I just can't believe it's a secret. So wholesale lenders, and you might recognize the name MCAP or First National. If not, you can Google them and check them out. They're examples, right? And you don't see them with retail banking, but they have far lower rates for what are called insured mortgages. Remember, if you pay under 20% of your down payment, you have to pay for mortgage default insurance. And yeah, they're actually really good for rates there. In fact, they're fantastic. So just to give you like an example here, Marathon Mortgage. Who's heard of Marathon Mortgage? I'm sure there's one hand. I'd be surprised if there's more than one hand. So Marathon Mortgage, yes, they're a real company, kind of a funny name. They have 1.98 for their variable right now, where TD Bank has 2.35. So then it comes down to, well, what's the math of the amount of interest and payments you have over the life of your mortgage? You get a 1.98 versus a 2.35. May not seem like a big discrepancy, but over a 25-year mortgage lifespan, assuming you hold those rates, it's $28,000 that you can save by going at 1.98 versus 2.35. Now, this is on a $500,000 mortgage. Of course, the more mortgage you have, the more of these rates are amplified, right? If you've got a smaller mortgage, the spread's a little shorter. But yeah, that's just a bit of like an FYI. And one thing around breakage penalties, I talked before that it's not just about rates. Remember, you want to save the most money over time. And again, it's about 6/10 of people that break their mortgage. And that's anywhere from 15 grand to $40,000 you pay as a penalty for breaking your mortgage, whether it's intentional or not. So you're basically locked into a mortgage, which for some people it can be a problem, especially if 6 out of 10 people break their mortgage. So think about the fine print, ask your broker about that. And again, usually with one of these monoline lenders, they'll do 3 month worth of interest. It's gonna be anywhere from $2,000 to $5,000. So pretty reasonable. It's a big gap. I talked about rental income. A lot of us will not have enough income relative to debt according to lender standards. So if we have a basement suite that we're renting out and we're getting money for that, and we want to use that as our income to qualify for more, some lenders don't even accept all of that income. They might do 50% of it. Some will do 100% of the income. And a lot of these people are not the banks. So again, it's important to keep all these factors in mind because your goal again is to afford more and save more money. That's what it's all about. So yes, surprises to avoid. And again, I've covered the tip of the iceberg, but I'm gonna dive a little bit deeper in like the most common mistakes that I see. So a lot of people just afford less than they want. So they'll go to Alex, hey Alex, I want a $800,000 home. Alex is like, well, he'll probably be like, are you pre-approved? Right? Some realtors may not, or you may just be looking at listings online and like you're house shopping, but if you don't know what you can afford, you're kind of wasting your time. So get pre-approved, and that's basically having a call with me either on Zoom or a phone or in person if you like, of course at a safe physical distance, just to kind of assess a bit of your profile. And then yeah, you basically have a stamp of approval, whether it's an official pre-approval through a written one that I can get from some of my lenders, or I give you a 95% estimate on where you're at right now and where you can go in the future. So that's really important. So know what you need. A lot of people pay more than they need to, mainly because of credit score. They just don't know their credit score nor what actually affects your credit score. Remember, 35% of what affects your credit score is paying your bills on time. The rest, usually people don't know about. So we'll talk about that in one of the subsequent slides. And then, yeah, one thing as well, the reason why I said that I can pre-approve you to 95% of what I think is going to get you to, of course, certainty, is that your home actually influences a lot of how much you can afford for your mortgage. You can, let's say you make $500,000 a year, zero debt, and a perfect credit score of 900. You may still get turned down because think about it. If you're a lender and you're giving, and their only collateral for you maybe not paying is the home, and the home is water damage or anything like that, that will actually get you blocked at the last minute. And I see it time and time again. There's that thing. And of course, yeah, if you don't have a big enough of a down payment for the value of your home, if your home's over $1 million, you're in trouble. So you really got to know the relationship between the home value, and how that affects you. So again, on the pre-approval side, this is something that, again, you can look at after today's chat. But end of the day, a pre-approval is when you are seeing how much you can afford and at what rate. Something people also don't know is, as you guys know, the rates right now are below 2%. That's, close to historic lows. So that probably won't last forever. And if you do get a pre-approval, you can actually sometimes get a rate lock, like a rate hold. So if the rates do go up, and you're within an 120-day window, sometimes even more, depending on the lender, that rate, you get an honor on that rate. And if the rate actually goes down, they can float you down to what's actually lower than what you got locked in at. So it's kind of a way to hedge your bets. It takes precisely 28 minutes. I've timed some of it, and it basically is less than half an hour. And you can save 10 grand on this because actually, if you go back to a little bit of math, if you have a rate of 2.10, and let's say in 4 months it shoots up to 3.10, which it doesn't happen very often, but it has happened, then the difference between getting a 2.10 and a $500,000 mortgage and then having to pay a 3.10 because you didn't get pre-approved and you didn't lock a rate is $10,000. So do your due diligence. It doesn't take long, and it lets you know where you're going. I have a lot of this on the blog. You guys can check out on levelupmortgages.com. And of course, we can chat about it as well. An asterisk here too is if you're getting to pre-construction condos, which Alex will cover more, sometimes they won't close for like half a year or a year, and there's special mortgages that let you hold on to either the rate or be pre-approved for a certain amount of time, longer than 120 days, and then you have to refresh your application. But you have to get pre-approved so that you can put in that deposit with confidence, and then once it's going to complete, once you actually move in, you've got to refresh that, and we can talk about that later. But that's a bit about pre-approvals. And then yeah, credit score. So here is me unveiling what actually affects your credit score. So the first thing is, good payment history. That's you paying your bills on time. Credit utilization. This is, and the way I actually pay my bills on time without stress is I just set up pre-authorized payments. Call up your bank. It's all in autopilot. They'll pay the monthly credit card fee, and boom, it's out of sight, out of mind, which is personally a way I like to do it. Credit utilization. If your credit limit is $10,000 on your credit card or your line of credit, if you are spending $4,001, that's starting to affect your credit in a negative way. If you're at $8,000, that is not good because they know you're towing the line. So that's actually like almost as important as paying on time. So a way to avoid this is to get more lines of credit or more credit cards, of course, in a responsible way. And in total, you want to be under 40% of what the aggregate of your credit limit is. Really important. And one thing as well is don't close your credit cards once you're not using them or your lines of credit. Try to keep them active. There's a rule that says to build credit, you need 2 lines of credit. You've got to have them for at least 2 years, and you want to be paying the difference at least twice over, right? So it's a very important rule that can keep your credit card active. So basically, you want to keep your lines active, even if it's just paying for something on a credit card you never use, $20, and then paying it back. Question right now, a quick one. With annual fees, sometimes the cards have annual fees, so you have to do the pros and cons of that. Look, if you are within 6 months to a year of actually getting a mortgage or in the market, I would say pay the $100 because the risk of that dinging your credit score is probably going to be more costly than you having to pay more for another lender. But again, talk to your local mortgage broker and find out what your score is. If you're like a 800 or 750, this might affect it, 5, 10, 15 points, right? Which isn't that much, right? Just consult, but just know that actually affects your score. Again, do not cancel credit lines, especially if you're within a year of doing it. And the consequences are that you may have to pay more interest with alternative lenders. So those are lenders that still don't have the worst rates, but they're a little bit more, right? And they'll be more flexible on your credit, by the way. And there's definitely a time and place for them. But, if you can avoid them, it's probably better. And with any alternative lender, these are people that maybe charge between 3.7 and 6%. You have to put down at least 20%. So just by not keeping your credit score where it needs to be, you could be just having to save a lot more money or pay more than you need to. So just talking about the home really quick, I mentioned this. Ask your realtor, ask Alex, ask whoever, what are the building features that may cause concern? And these are all things here that you just have to basically ask your realtor about and they'll know. But just know what questions to ask because for all these reasons, lenders won't touch a building if it's not good collateral. Really important. There's a cool tool as well called the Eli report that actually uses AI to review some of your strata docs. So that's something as well you can kind of talk to your realtor about if they don't know about it. And you can also save some time because it can be, of course, a lot of paperwork and very overwhelming. Things like age restrictions. Some buildings only allow people 55 plus, which is great because it's quiet for them. But when it comes to selling that, the lenders see it as they have a limited market and therefore they may not see it as something they want to lend on. Some buildings have a large fund as well, a contingency reserve fund, like a fund basically to repair damage. And you actually want to sometimes ask, like, what is the contingency reserve fund? And they'll be, oh, I'm surprised you know about that. But that's actually really important to understand how much there is for backup if something happens. And one thing as well is that, let's say Alex gets you a really good deal on a property. You may have the issue where he gets you a good deal and you or how about this? Let's say that, let's put it this way, actually, you actually have to pay more than the property is worth. Okay. You have to pay more. It's a bidding war. So you have to pay a little bit more. It's still a good deal because you love the property. You pay $600,000 for the property, but the market rate for it is actually $500 or $550. Now that means that the lender, when they order an appraisal, so they actually see how much it officially is worth, not through negotiation, but the market price. If they get $550, they will lend to you based off the price of $550, which means you're probably going to be $50,000 short on the mortgage. So it's actually very important that if you do pay more than what is the market rate, that can limit you in how much mortgage you get, and the rest comes out of pocket. So make sure that for your appraisal, you understand that even the minimum appraisal out there will still not affect what you have to pay on the down payment side.
Paul, I'm just going to chime in here quickly.
Sure.
Sometimes you will still get approved for a building, but there could still be issues once we read through strata documents. And just to clarify, if any of you don't know, this is with condos and townhomes and the complexes. Basically, these documents outline, as you said, contingency reserve fund, which is a fund that they save up in case of any major expenses such as a roof replacement. So the due diligence period, your realtor, make sure that they're familiar with strata properties, how to read through these documents, because you can even see here how many different things there is to look for. And if they don't know what they're looking for, you don't want to end up 2 months after you purchase it with a $15,000 extra expense because your realtor or yourself wasn't able to realize that they had to replace the roof. So anyways, continue on.
Yeah, no, that's an awesome anecdote. Thanks for that, Alex. Yeah, so those are all, again, real life stuff that we see that we would hope that you can at least know who to ask and how to ask so that you're not having to face that. And yeah, this is sort of an interesting thing. Your accountant and your mortgage broker will not like each other because they have very different incentives. So what does your accountant usually tell you to do? Write off everything. Obviously, you pay less taxes. Now, the problem is, especially on the mortgage side, is that whatever your notice of assessment says, or your T4, your T1 general in this case, if you're self-employed, is that the net income after you deduct the expenses is a lot lower than what you actually make. So if you write off expenses, you pay less taxes, but also you qualify for less of a mortgage because, especially the banks, like, oh, so you make $50,000. Okay, well, you're going to qualify for what's equivalent to making $50,000. Be like, you're like, no, I make $80,000. I just write things off. Like, nope, we said $50,000. We're going off of that. That's where actually, again, with other lenders, they can be more flexible to see what you really make by looking at your bank statement or looking at, I guess, yeah, like what you invoice people, or you can state your income even. There's a lot of interesting programs where if your problem is that you've written off too much, there's still ways out of that. I should say as well that banks want to see at least 2 years of self-employed income. If you don't have that, they're not going to qualify you. So that's where you want to go with, again, some of these wholesale lenders. And yeah, I covered these 2 points. So yeah, again, self-employed. I mean, it's hard enough being self-employed. So the last thing you want is this kind of trouble. So again, things that I'm happy to chat about. And yeah, let's transition over to the exciting stuff. Thanks for your patience. Those are all things that, again, you need to know before you can really look into the market. But yeah, I know the juicy stuff out of today is, yeah, learning about what's happening in the market. So yeah, Alex, take it away.
Awesome. Thanks a lot, Paul. And of course, you're going to want to get all your finances in order because without that, the rest of this doesn't even matter. So thank you so much, Paul, for sharing that. But what I'll go over with you guys here first is just a recent history of the market to get a broader overview. So what we're looking at here is the Fraser Valley, the Langley, and the Surrey markets. So what I want you to think about is this quote right here. It is, the real estate market goes up and down upwards. I'll say that one more time. The real estate market goes up and down upwards. So it works in cycles. It goes up and down, but over the long run, historically, it has always worked its way upwards. So as long as you're taking a long-term approach to real estate, it's always going to be a great investment. So what I want to show you here is 2 of the most recent major drops in price. So back in 2008, 2009, as you can see on the left side of the screen, we saw a 10% price drop. And this was a little bit outside of this graph. However, by 2010, we actually had a full price recovery and then started to trend back upwards. Now, yet again, we look at peak prices in May and June of 2018. And by November of 2019, we saw again another 8% price drop. And as of today, we were basically back at the same level and moving back upwards yet again. So what I want to basically show you here is that it's not about trying to time the market, but it's about time in the market. So again, as long as you're trying to take a long-term approach, you're always going to be okay. We can't necessarily predict exactly when these peaks and when these values are going to be, but we're going to make good estimations on when are good opportunities to get into the market. So moving on to the Fraser Valley itself, we want to look at the last 18 months in the market and what has been going on. So if you see these 2 graphs here, these are for attached properties, which are townhomes and condos. Now, I'm going to say it's probably safe to assume that the majority of you, like myself, are looking at townhomes and apartments because you might not have $1 million kicking around for your first home. So basically in the first 10 months of 2019, up until about November, many buyers were kind of in a wait and see position. They were hesitant. There was some government policies that they were still getting used to, such as the stress test and foreign buyers tax. Inventory was very low. The number of homes was very low, as well as the number of buyers. And something that I want you to remember as I continue to present is some general economics. The level of supply and the level of demand is going to play a major role in prices. So supply being how many listings and demand being how many buyers in the market. So over that 10-month period, we actually saw prices fall by about 8 to 10% into about November of 2019. Now, it was at this period of time that we actually started to see a reversal in prices, as you can see in both of these graphs. And many buyers started to flood into the markets that were previously on the sidelines. So once people started to see this, they didn't want to miss that bus back up. They had FOMO, and buyers continued to flood into the market, which is why we saw prices begin to rise. However, the number of listings didn't increase significantly, but it was slowly increasing. Now, as we get into early 2020, January and February of this year, again, inventory slowly creeping up, but there was a ton of buyers forcing prices upwards yet again. However, March 11th came around, the WHO announced a global pandemic, and the real estate industry came to a screeching halt. There's several reasons for this. There was a ton of uncertainty, there was a ton of fear, there was social and physical distancing measures, as well as the Fraser Valley and Greater Vancouver real estate boards themselves canceled open houses. Landlords are actually not allowed to remove tenants or evict tenants for any reason whatsoever, which means if they had a rental property that they wanted to sell and someone else wanted to purchase it from them and move in, they couldn't do that. So again, limiting the amount of inventory that could come onto the market. And just one additional point is we had a ton of forms and liability and all these other things that we had to do every time we listed a property, every time we showed a property. It was a massive hassle. And so we weren't necessarily advising people to get into the market at that point in time because, again, so much uncertainty. We didn't know the extent of this virus, what it was going to be on the economy, what it was going to be on people's health. So obviously that is why kind of things came to a screeching halt. But looking at the most recent few months, in April, this is where we actually got hit the hardest. Now, the reason for this being is that there's a slight delay due to the fact that if you're looking for homes on March 11th, right, and all of a sudden a global pandemic is announced, you're not just going to stop if you've already sold your home. In addition to that, there is a subject removal period. So even if you have an accepted offer, it doesn't show up as a sold property for another 7 to 12 days. So that's why I kind of trickled into April. But anyways, again, you can see the number of home sales and the number of listings were significantly down, over 50% in both. However, again, looking at supply and demand, the number of sales didn't drop by as much as the number of listings, which actually held prices quite steady. And we actually saw some minor increases in many areas. Heading into May of 2020, again, we started to see home sales start to creep back up from the previous month, but look at listings there, an increase of almost 56%. So there was a flood of new listings, which again, at this point in time, created a bunch of new inventory. But as I mentioned, there wasn't that many buyers yet. And this is still the case right now. So as we look at June, up until yesterday, the market has basically completely turned around. We're actually our numbers are looking better than they were last year. Again, up by nearly 10% in both categories. So, but what I really want to illustrate with this slide is what does this really mean for you as a buyer? Well, these next few months are a great time to buy because, as I said, there is less competition out there at this point in time, and there are still more listings coming onto the market every single day. Now, many of these buyers are still holding off due to many reasons, whether it's uncertainty, whether they don't have their job yet. But if you're in a position to buy in these next few months, I would highly advise you take advantage of it. Now, additionally, there are still some potential deals from those people who continue to be impacted by COVID, whether that's loss of work, whether that's some sort of financial distress. Unfortunately, I actually heard recently that several divorce lawyers were getting many, many more inquiries due to the whole COVID thing.
Right.
I mean, unfortunate for them, but it does present an opportunity for you. And lastly, is just low interest rates, as Paul mentioned before. Borrowing is very cheap right now. Getting a mortgage is, again, more beneficial at this point in time.
Totally.
So now let's look at where the market is headed. Well, first of all, I want to outline this market report made by the CMHC. This is basically the Canadian Mortgage and Housing Corporation. They are the largest mortgage insurer in Canada. And this was on May 27th. They were actually forecasting that the entire Canadian market was going to drop by 9 to 18% from its pre-COVID levels. Additionally, they mentioned that it was going to, the number of sales were going to drop by 19 to, I believe, 28% from pre-COVID levels, and that we weren't actually going to see a return to those levels until late 2020. However, as you just saw on my previous slide, we have already surpassed those and are continuing to climb. So reason number one, why this isn't accurate, we've already surpassed those levels. We're in month 6, and they were talking not until month 9, 10, 11. Additionally, this study covered the entirety of Canada. Now, if we look below on the left-hand side, that included Alberta and Saskatchewan. If you look at BC, prices actually rose over this time period and have continued to, whereas places where oil is a major industry, Alberta itself has been hit hard and will continue to be hit hard. So again, we are grouping that in with BC, which doesn't necessarily make sense. What you have to understand is that there are markets within markets. Just because prices are going down in Vancouver doesn't mean they're going down in Toronto. And we actually saw prices moving in the opposite directions this past year as well. Now, additionally, BC did a very good job of containing the virus based on all the measures that we took. But we haven't seen the same economic or health impact, and we've actually, again, been able to open up these restrictions, not being impacted as much as all those other areas. And lastly is that this study basically was a worst case scenario. They rushed it, they got it out to market. However, as all these points that I've just covered basically disproves it for, like, again, we can't look at Canada as a whole, we have to look at each individual market. Now, what I want to move on to now is why exactly our market is going to continue to trend upwards in the long run. Well, number one, Vancouver and the Lower Mainland, it's a highly desirable location. You can't argue against that. It is arguably a worldly city. How many places in the world can you be at the beach and the ocean and then in the mountains within a few hours, right? It's an incredibly, again, the nature here, the views, the wildlife, just everything about it draws people here. However, we have a finite supply of land, especially in the Vancouver region. It is not a very big area. We can't build out anymore. We are now having to build up, but we're running into problems. The issue is that it is very difficult to get zoning and restrictions lifted in order to build these condos. So we can't actually keep up with the demand, once again, of people moving here for work, immigrating, all these other factors, which is again driving prices upwards. So what does this mean though? It's going to start driving more and more people into the Fraser Valley for several reasons. Number one being affordability. Think about how much more land, how much better property you can get in Surrey or Langley than if you're in Vancouver. It's astonishing. And actually during COVID, this actually made it very apparent to many people. The reason being they're cooped up in their house. They realized, you know what, I want a lot more space. Now, in addition to that, a lot more people are working from home either on a part-time or full-time basis. They don't have the need for that transportation anymore. And as long as they're not tied to the city, why wouldn't you move out this way? And lastly is our transportation is continuing to improve. We're getting the SkyTrain coming from Surrey to Langley by 2025. So again, even if they do have to get there, it is becoming easier and easier to transit and transportation there, sorry.
Yep, awesome. Totally, great points, man.
We're moving on. So now that you have a bit of a better understanding of where the market's been, where it is now, and where it's going to be headed, let's actually talk about the home buying process. So I know a lot of you guys said there is a lot here. I'm going to rip through it, but just to give you a general idea. So number one is getting pre-approved, as I've already said. You go see Paul, you go see a mortgage broker, figure out where your budget is. We can move on from there. And the biggest reason I learned very early in my career, you don't take people out who haven't been pre-approved, because what happens, they fall in love with the property, we make an offer, financing falls apart, we lose the deal. Now they're heartbroken. They've wasted their time. They've wasted my time. They've wasted the seller's time. And it's just, again, a big waste of time.
Crushing. And also there's people that sometimes they don't get pre-approved, or they don't get approved at all. They put a live offer, they put down the deposit, that they usually have about a 7-day process. When you put your deposit, they accept it to when the deposit goes from the trustee's account into the seller's bank account. That's non-refundable. So some people have literally had financing fall apart, or they just thought they had financing complete, especially if it was a pre-construction and they did it, a couple of years ago, and then suddenly, boom, financing falls through, they lose their deposit. That's even a worse story. And there's stories of people losing like $50,000 deposits because they just didn't do their due diligence. So yeah, scary stuff.
Yeah. So moving on, once you've determined what your budget is, then you're going to be able to create a wish list. So you're going to talk about your location, what type of home, is it a condo? Is it a townhome? What are your needs? What are your wants? Like, what is your deal breaker? What does absolutely need to have? Now, if you are going to have a very good idea of what exactly you're looking for, and others of you aren't necessarily going to have that until you start looking at homes, and then you're going to have a really good idea of what it is you're looking for after you've seen a few. So at this point in time, we're going to start your home search. Now, the best way to do that is I would be able to create a custom home search. I have access to a platform called the MLS, and this is basically where all the listings from all the realtors are filtered into. We can get very, very detailed in what we're looking for. And in addition to this, I have access to another tool called Hot Sheets. What Hot Sheets is I can actually see properties before they've hit the market. Now, in a competitive market and with very attractive products, so for instance, maybe you're looking for a 2-bedroom condo in a very specific complex, I can find out about that before, again, it's hit the market. I can potentially get you in there before anyone else, or at least on day one.
That's huge.
So along with this, we have professional photos, virtual tours, videos. You can really filter down what you're looking for online at this point in time. We don't always have to go out and look to find these properties. You can do a lot of due diligence prior to. Next, we would go and actually view homes. You would send, let's say, 3 to 5 homes that you like. And the best way to go about this is what I would do is book a buyer's tour. And what this means is, again, you would send me 3 to 5 homes, typically in the same location. We would book, a 2 to 3 hour period in a morning or afternoon, or really whenever works for you. And we go bang them out back to back to back. Now, during this period of time, we would have a note board, taking notes, saying what we like, what we didn't like, because I can tell you from experience, once you've been in, if you're looking at condos, let's say a 1 or 2 bed, once you're gone to number 1 all the way to number 5, you start mixing up bedrooms. You start like which one had the granite countertop, which was facing, the green belt, and which one was on the highway. So you have to be very organized during this process. Now, next, once you've actually found that home, at this point in time, we're going to make an offer. Now, there is a 6-page legal document that your realtor will fill out for you. There is a lot of legal mumbo jumbo that they'll have to explain to you, but there's 3 important things. It's not just the price, but also the dates and the subjects. Now, I will get to the subjects in a couple more points, but your subjects are basically conditions that you must approve of even after you've had an accepted offer. There's a due diligence period. Again, I'll get to it. And if you tick off all those boxes, then we're going to go through with the sale. However, there are 3 important dates that you need to keep in mind. There is completion. This is the date when the title of the property actually is transferred from the seller to your name. This is about 1 or 2 days prior to actually moving in. We then have possession. This is the day that you move in. And we have adjustments. And what adjustments is basically the seller has actually prepaid their property taxes, their utilities, or other expenses to the end of the year. So based on when you're purchasing it, you're going to have to reimburse them for the amount that they've already paid for. So once you've made an offer, the seller has 3 options. They can accept it, they can decline it, or they can counteroffer. If they decide to counteroffer, what they're basically going to do, take a look at your offer. You're going to look at your price, your dates, your subjects. They're going to tweak them to their liking, and then they're going to send it back to you. And at this point, we're in negotiations. So now when you receive it back, you actually have the same 3 options. You can accept, you can decline, or you can counteroffer back. So you may decide with your realtor, you know what, we're going to meet like maybe you want to change the dates, but you're not willing to move on the price. Once you kind of come to an agreement, now we have an accepted offer. However, this isn't the end of the deal yet. Next, you're going to move on to the subject removal period, as I mentioned before. So based on the subjects that you have in your contract, you're going to have a 7 to 12 day period, which you're going to be able to, again, do your due diligence, make sure everything lines up. So number 1 that we're typically going to have is financing. Now, if you've gone to Paul, if you've gone to a mortgage broker and done your pre-approval, 95% of the time, we're going to be fine here. Everything's going to be good. You're going to get approved for that mortgage. But in some cases where the lender doesn't like the building for some reason, then it may not go through. But again, it's diligence. Again, up front, do you want to add something?
Sorry, Alex, is that I've had some cases where the sellers insist on the actual completion date when they move in to be like 3 to 4 months out in the future. And sometimes that's beyond the window of how long your low rate is held for. So make sure to negotiate if you can. Hopefully you want to move in within a few months or even within the month, right? But if they push it out that far, sometimes people are scared of the whole COVID thing. They don't want to do all the moving. Just check with your broker and just see if that's going to affect any of your pre-approval or, of course, your actual official approval. Just a little tidbit there.
That's a good point. Thanks for that. So again, once you've ticked all those boxes, everything looks good to you. Well, there's a few more that we will go over actually. So number 1 is a home inspection. So this isn't mandatory, but I highly suggest it, especially in resale properties. You're going to hire a home inspector for a couple $100. He's going to go in, make sure there's no hidden defects or things that could come up as major expenses after the sale. Because again, the last thing you want is to have this hidden $10,000 cost that you didn't know about because you wanted to I don't want to say cheap out, but you didn't want to spend the money on that home inspector. It just gives you peace of mind. And for such a large investment, a couple $100 more really is your best option here. Now, the last two things are a property disclosure statement as well as strata documents. So as I mentioned before, read through those with your realtor. It's very important to have one that understands and knows what to look for, because again, you don't want a special assessment such as a roof or something that is coming up in the near future, and all of a sudden you're hit with a $15,000 fee. Just not something that you want to do. It's not the best way to start off home ownership. And then lastly is moving into your new home. Now, this is typically about 2 months after you've got an accepted offer and removed subjects. However, this can move in either direction. However, this is kind of the average. But if you're living at home or renting, or based on your situation, this is something that you can actually kind of negotiate with the seller with, because sometimes dates can actually go a little further than the price. So if you're in a situation like that, always something to keep in mind. Now, once you're moving in, there are a few closing costs you're gonna have to keep in mind. You're gonna have to hire a lawyer or notary. You may have to pay GST, which would be 5%. This is only on new build or pre-sale buildings. You could have mortgage insurance. That is if you have less than a 20% down payment. You may have to pay for moving fees, as well as adjustments, which I mentioned before, but those are things to kind of plan for a little closer to that time.
Yeah, and property transfer tax is one as well. And like basically, and this is something lenders make you do, is that take 1.5% out of your home value, and that's going to be what they actually want to see saved in your bank account. They want to see bank savings that you've budgeted for your closing costs. So yeah, they're usually, I mean, if you have a $500,000 property, right, 1.5% is what, 5,000 plus, it's probably what, $7,500. So anywhere between $7,500 or of course more if it's a more expensive property, that will probably be about, I see a lot of it at 10K, honestly. So save the extra 10K for closing costs. It's something you're going to have to actually prove to the lender that you have saved for. So a lot of people forget that.
Yeah. And additionally, there, as a first-time home buyer, if the property price is under 500K, you're actually exempt from paying that. Yep. And on a new build or a pre-sale under $750,000, you don't have to pay that as well, which is, it's great amount of savings.
Totally, it's a good chunk of money.
Yeah. So now let's move on to the actual two property types you'd be looking at, either a pre-sale or a resale. So pre-sale typically, is going to be potentially 2 years out from when the building completes and you're able to move in. So some of the pros of this are the deposit structure. It's between 5 and 20%. There are a ton of units at this point in time where you only have to actually have a 10% deposit, and that is split up over a long period of time. So you may have to pay 5% up front and then another 5% at completion, which is kind of nice. You don't have to pay that big lump sum up front. Additionally, you don't have to qualify for the mortgage until the building is complete. So if it's not done until, let's say, June of 2022, you don't actually have to get that mortgage until that period of time. And this can be very beneficial for someone who you have a raise coming in your future, a better position at work, or you're self-employed and you don't have 2 years worth of income yet. Now, next is you're able to save money when you get in early. So pre-sales are sold in tiers. They have like phase 1, phase 2, phase 3. And the more units they sell, they move on to the next phase and prices begin to increase. Now, the best way to get into pre-sales earlier than the other people is to have a realtor that has relationships with the developers, is on top of these things, and knows when opening weekend is, and basically has VIP access for you. Now, I do have some of these types of opportunities. So afterwards, if this is something you're interested in, I can fill you in more. But basically, not only do you want to get in first because of the price, but you also get first choice of units. This could be the difference of, staring at another building or staring at a green belt.
Yeah.
Additionally, there is the appreciation potential and the option to assign. So if you're not familiar with what an assignment is, basically, once you put down that deposit and you haven't actually taken possession of the unit because it's not complete, if it increases in value from the time that you get that initial accepted offer and the time that the building is complete, with some developers, it might be about 50%. With their permission, you can assign or sell that contract. Now, you'll have to pay them a small fee. However, you can keep basically a portion of that difference. So without ever moving in, that can be a great investment strategy. Or, I mean, this was a big thing in 2016. Yeah. Next is that you can customize the unit to your liking. Sorry, do you want to chime in, Paul? Or
no, just agreeing. Yeah, for sure.
Okay. And you can customize the units to your liking. So typically these are different color schemes. You can get additions with, different flooring or countertops or all these things. And this is where you really want a realtor in there for you, because they're going to be able to negotiate here. So with pre-sales, they're not very negotiable on the price, but you can negotiate for additions and bonuses and things of this nature. But this is another point I need to make here, is that if you've ever been into a pre-sale showroom, they have salespeople there. Now, this is the same thing as a bank. These salespeople work for the developers. They're not there to negotiate or get you a deal. They're there to push products on you. Whereas if you bring your own realtor, again, no additional fee. They're going to be able to negotiate for you. And they may also advise you against it. If they know who the developer, the builder is, and they have a bad reputation, the salesperson's not going to tell you that, but your realtor will. And lastly, it's just there's an additional warranty with it with a new one. Cons, there's potential completion delays. So again, they tell you June of 2022. There's a potential that it's a few months late. You just have to keep it in mind. It is a risk, not the end of the world. Next, you don't get it immediately. So if you're wanting a property to move into, in the next few months, this may not work for you. And lastly is GST. So you're gonna have to pay 5% on top of it. However, if the property is under 350,000, you can actually get a rebate on that, but we could cover that if that was the case later on. So now looking at the pros of resale. Well, typically it's lower priced, it's a little older, it's more renovations that you can do there. But one of the biggest things here is there's more negotiation potential. You can actually get your realtor to go negotiate with the seller and the listing agent themselves. And there's usually a lot more leeway for, again, negotiation and price. You get the property right away. So if you're looking to, as an investor, to tenant it or as a buyer to move into it, again, you're going to get it, 2 months from the time that you actually purchase it. And lastly is the ability to renovate it. So if you find a fixer-upper and you are a handyman or handywoman or have friends who can do this, I have here in brackets sweat equity. And what this basically means is you put a certain amount of money into a property and actually get more out. So let's say you do $20,000 worth of renovations, but you've actually increased your property's value by $40,000. So you've built $20,000 worth of equity. And not only this, if you're an investor, you want a rental property, you can now rent it out for higher rates. So not only have you increased the equity and the resale value, but you can also charge higher rents. Now, some of the cons of this, basically there's more potential repairs and expenses. Again, you're gonna have to check strata documents, make sure there's no major fees or assessments coming up. It's gonna be less attractive to tenants, but again, that is fixable. And less attractive means lower rents, but again, not the end of the world. Now, this is the money slide, so pay attention here. I want to tell you guys about the Fraser Valley hotspots and the investment opportunities. So to start it off, we're looking in the South Surrey and White Rock areas. Now, if you're someone who likes to be near the beach, a little bit of a more laid back vibe, this area has actually dropped the most in the Fraser Valley. Now, when I showed you before that we had about, an 8 to 10% decline, and then most of the market was coming back up, South Surrey and White Rock actually continue to decline. So the attached market, condos and townhomes, are actually very undervalued at this point in time. They are still down by roughly 7% each. As well, the attached market is actually down by almost 14%. However, I'm not sure how many of us have $1.3 million kicking around to buy a detached property. So great area if you're looking to either live in or rent out. And you're still only about 45 minutes from getting downtown. Now, moving on, the next area is going to be Carbolt. So if you look at the little map here, it's kind of at the top. Now, this is the next hotspot in Langley. Basically, there is a major transportation hub here called the Carbolt Exchange, as well as Highway 1. And when you're near major highways and major transportation hubs, this is going to not only allow you to charge higher rents, but it is going to give you a greater resale value. Now, they've released the neighborhood community plan, which can be found on the Township of Langley website, or I can send it to you if you're interested, which basically outlines their plans for the next 10, 20, 30 years. And they have an incredible community plan in place. They are building a community based around, they're building residential homes, they are building commercial stores, they're trying to improve the amount of jobs there. Everything's going to be walking distance, it's going to be green. And again, recently it was Yorkson, which is a couple blocks south of that. But again, Carbolt is the next hotspot. So definitely keep an eye out. There are new developments going in there, which I have access to. If that's something you're interested in, definitely shoot me a message. Now, lastly is the Clayton and Langley City area, as you can see highlighted. Now, as many of you may know, this SkyTrain is set to come directly down Fraser Highway into Langley to about 203rd. Now, again, as I mentioned, when we get better forms of transportation, especially the SkyTrain, this is going to skyrocket prices and again, allow you to charge greater rents. Now, both areas are great rental potential if you want to purchase you know, a unit, an investment property, but they're also great places to live. And Clayton has kind of a mix of townhomes and condos, whereas Langley City is a bit more condo focused. Now, Langley City has older buildings, so if you're looking to renovate and try and get some of that sweat equity, as I had mentioned, I would suggest Langley City. However, there are some great new developments coming right where the end of the SkyTrain is. I actually just sold one to a client, which I'll cover shortly. But Clayton, again, great area to live, lots of young families here. Both areas are continuing to be developed. So again, I stay right on top of these. I have, you know, good relationships with all the developers, and I have all the information if that's something that you'd be interested in. Now, what I want to tell you about is some of these opportunities in Langley City, especially the one that I just helped out. Some of you might actually be in the same position as my clients are in, maybe not quite, but basically it's a husband and wife, and they have an incredible rental deal in Vancouver. They have 1,300 square foot floor of a detached home, which they split with the husband's sister, and they pay $1,000 total. So like 500 between the couple and 500 between the other two, or the other one, sorry. So I told them there's no shot you should give that up. They're in Vancouver for $500, right? But they saved the money. They wanted to purchase the property. So we looked at this as an investment potential. So we were able to get them a 1-bedroom pre-sale unit right where the SkyTrain is going to end up for $329,900. And now there are units ranging from $299,900 basically for a 1-bed, upwards of, you know, 2 bedrooms are probably starting in the 370-ish range. But again, more and more things coming to the market all the time. I can always get you information if that's something you're interested in. Moving on. I know we're a little behind, guys. I apologize, but thank you so much for sticking around. But that about does it for us. So basically, what are the next steps? Well, first of all, I would highly suggest you have a conversation with both of us. We could have a consultation, and whether you're looking to purchase in the near future or not for a little while, I still suggest you do that, because if you take one thing away from this presentation, it is to be proactive and plan ahead. So by having those conversations with us now, it's going to set you up for the future, again, regardless of if you're looking immediately or down the road, because I would hate to see you, you know, number one, maybe you don't know what your credit score is, or you could have been in a better financial position and you have to talk to Paul. So of course, speak with Paul, see where you're at right now, and figure out what you need to do or what you need to change in order to be in a better position later, or figure out where you are right now if it's something that you want, are interested in pursuing. And at this point in time, I just want to say thank you for everyone who stuck around. We did put a ton of work into this, so we hope you got some value out of it. Tried not to be too serious, but there is a lot of information to cover. So if you have questions, and don't hesitate to reach out to either of us, whether it's a DM or a call or a text or whatever you want to do. And we will be sending the recording out to everyone, I believe, Paul.
Pretty quick. Yeah, we're going to put it on YouTube. Might even do some fancy editing to kind of make it really kind of compact. So we'll send it out. Definitely. I mean, I'd say, you know, latest a week from now, maybe before that. So yeah, keep in touch. And yeah, we'll stay in touch with you guys with updates on the market as things go on. So yeah, I'm super grateful on my end as well. I'm grateful for Alex, who, you know, who was basically the hero of the show, talking about, of course, all the focuses on the Fraser Valley. I mean, yeah, some really good opportunities I obviously didn't know about. So I think learning for everyone, and just advice again is just make sure you know what questions to ask. At the end of the day, you make the decisions, but you need to be informed. And yeah, there's a lot of ways to do that, but it's always nice to get one-on-one advice so you know where you're going. So yeah, thanks to everyone. And if there's any last comments, please put them in. Otherwise, go enjoy hopefully a bit of sunshine and maybe a nice barbecue, and maybe in a nice restaurant that's opened up. We got to support the local community. So thanks again, everyone, and be well. And we'll surely be in touch. Here's the contact info. You can subscribe to my YouTube channel. You've got Alex on TikTok. Again, there's multiple channels. We're a bit more progressive here. We're pretty flexible. Get in touch anyway, and just do your research, right? And we look forward to seeing you guys level up.